Guys, I'm devastated. PayPal beat all estimates. Earnings estimates per share were 87 cents. They reported 93 cents, which is still down from a year ago. And their revenue estimates were 6.7 billion. They reported 6.8 billion. This is their quarterly report, their press release. Revenue is growing 9 and 10%. Operating cash flow grew 12%. Free cash flow grew 22%. I mean, guys, it's a crush. And of course, let's go to our software. How's it doing after hours? I am devastated. It is up 9%, up 1% during the day. Now, why am I devastated? Guys, I'm a value investor. My goal is to have stocks fall. I want stocks to fall so I can buy them. I had puts sold 50, 60, 70 bucks. I was hoping they would miss completely and just collapse so I could buy more. Why is that? Well, I believe that short-term quarter-to-quarter results don't really affect the long-term unless something substantially has changed. And PayPal is down a lot in the last year or so. It hit a 52-week high of 295 and a low of 70, which was reached recently. Guys, that's a fall of over 75%. And they just crushed earnings. So you're probably thinking to yourself, oh my God, I should buy. Pump the brakes. You should make an analysis of the company based on long-term potential growth, knowing that quarter to quarter it could miss. You use misses in the short run to hopefully buy shares at prices you love, right? So let's go look at their income statement. Actually, let's go through their 8 pillars. This is a beautiful company. All 6 check marks and the only 2 X's are valuation. What does that mean? It means we're just waiting for the price to fall. That's it. But the price won't fall when they're beating earnings estimates like this. So it's kind of disappointing for me. Now, in full disclosure, I've been a fan of PayPal, and I have puts written on PayPal at much lower prices, I said earlier in the video. Why do I do that? Again, I'm a value investor. I like selling puts so I can buy stocks that I want at prices that I want. I do not want $97 a share, or where it's at right now. What I do is I use our software to sit there and make estimates of the company based on a long-term perspective and wait for the price to fall to where I want it to be. You might sit there and say, what if it never falls there? It always does eventually. No stock is ever always good and always bad. If you're around in the 90s, Microsoft, Intel, Cisco, Dell, those companies couldn't miss. The only one doing well versus 1990s is Microsoft. And that wasn't even good 10 years ago. So be patient, arm yourself with knowledge, keep learning about investing so that when stocks do hit the prices you want, you have zero fear in buying them. I'm still going to pay attention to PayPal, even though it has scorned me today. It has told me, Paul, I am not for you today. And I'm okay with that. I do believe PayPal has a long-term potential for being even greater company than it is today. Why? A lot of people trust PayPal. I trust PayPal. Whenever I'm given the option to buy on a website, it offers me PayPal, I buy with PayPal because I know they're very customer focused. If there's an issue, I'm likely to be able to resolve it on my own with PayPal. And I love that. I can use PayPal in so many places. That makes a lot of sense for me. Okay. So low debt. Let's look at their balance sheet real quick. Cash on hand, $52 billion. Oh, look at that. Total liability is 55.2. They almost have enough cash on hand to pay off all their liabilities. That's impressive. Let's look at their cash flow statement. Let's see how they're growing their cash flow. So here I added, for those of you who are new to our software, I added this line here, but look at this cash flow. That was kind of a fluke year, but 6 billion, 4 billion, 5.35. So guys, look at this. Over the last 10 years, this has been the free cash flow, but it's been going up along the way. It fluctuates, but it goes up. That's what we want to sit there and remember, that when things go up and down, because look, their profit, their earnings per share is down from last year, but their revenue is going up and there's going to be short-term ups and downs. Your job is to buy it when it hits the price. So how do we know what price to buy at? Well, this is why we use our stock analyzer tool. This is the most popular part of our software, where these thousands and thousands of people who use it every single day sit there and make assumptions about the future. Every investment is the present value of all future cash flow. So your job is to make assumptions about the future, put them in here in terms of revenue growth, profit margin, free cash flow margin, future PE and price of free cash flow. And then finally, what's your desired return? How much do you want to make on your investment? Put it all in here and it'll tell you what to pay for it, not including the balance sheet, okay? So let's go make some assumptions here. revenue growth. Now remember, PayPal is part of eBay and it was spun off about 7 or 8 years ago. So we don't have the full 10 years of data. But I'm going to be conservative with PayPal. I'm going to go 4, 7, and 10% revenue growth. Profit margin, I'm going to do 13, 15, and 17. Free cash flow margin, I'm going to do 17, 19, and 21. PE, I'm going to do 13, 15, and 17. And why did I go much lower on PE and price of free cash flow? Well, guys, as the company gets bigger and bigger and bigger, it's harder to grow at higher rates of return, at higher rates. The PE and price of free cash flow should be higher based on moat, in my opinion, moat and growth rate. So as it gets larger and larger, the growth rate's harder and harder. Now, some would argue that the moat gets bigger and bigger as people rely on them more. Sure. But I'd rather be conservative. Why do I do 4%? Well, there's a lot of competition in the space. It could, and I mean, it has a great reputation, but there's still a lot of competition. At 10% growth, they can more than double in the next 10 years, which isn't egregious. The world's expanding. China, all these other, and yeah, China has Alipay and all these other things, but as the world gets larger and larger and larger, PayPal should be able to get a bigger piece, or even if it keeps the same piece of a much bigger growing pie, they'll still make more revenue. And finally, for my return, guys, let's start with 15%. Now, I usually do 12.5%, but I don't think PayPal can justify that right now because it has a lot more competition. I want a little bit more bang for my buck. So when I hit the analyze button, there are 6 numbers here. 3 for earnings and 3 for discounted cash flow multiples. Now, if they're all green, it does not mean go out and rush to buy them. It means go verify that your assumptions up here are correct. Do a little more research on the company. Yes, I know you want me to tell you go buy the stock or don't buy the stock. I'm here to teach you how to fish. I'm not here to just give you stocks to buy. The process is what works. If you just want me to give you stocks to buy, you're not going to sit there and put up with the ups and downs of the market. But if I teach you how to fish, if I teach you how to learn, you will be a lot less fearful when the stock goes down. If the numbers are all red or partial red, but they're close, keep doing your research. Keep doing it and be ready to buy when the time hits. So I hit the analyze button, scroll down below. All right. By the way, we just passed $100 a share. So we have a low of 30 to 40, a high of 70 to 85, and a middle range of around 45 to 60. Big ranges here, but guys, we're not far off. You might sit there and say it's not going to get there, but it was just a $280 stock just months ago, a year and a half ago. So keep that in mind. Be ready to act. Do your research. If you like this video, please subscribe to the channel and keep watching more. Thank you very much.